Welcome to Daniel Grant Economics, and today marks our first video with regards to CAPE Economics Unit 2.
Oh, well, that is extravagant news.
Today we are going to look at our first topic, and that is national income accounting. We are not going to examine all the elements, only the ones that I think pose a challenge to students sometimes. We're going to look at defining things such as economic agents, key terms in national income accounting, and 3 ways of deriving national income accounting variables. All of that in today's video.
Nice second pie.
Now on to the first objective of our video, and that is what are, or maybe who are economic agents. And this is probably the easiest part of the video. It is just important for you to know that economic agents are those persons or those entities who are involved in economic decision making. Primarily in this subject, we're going to be focusing on households, businesses, government, foreign sector, financial sector. Those are our economic agents. But for today's video, we're going to be looking at the circular flow of income as it relates to 2 of our economic agents, and that is households and businesses. Now that we know this, let's move on to open board. Great. Now that we're on open board, you get to see the simplified 2-sector model of the economy. This diagram only consists of households, which is why I have HH here, and businesses, these guys right here. Now, we are assuming this economy is closed, so there is no international sector, there's no imports and exports. We are assuming there is no banking sector, and we also assuming there is no government intervention as well. Where we start this analysis is looking at the fact that businesses send to the households goods and services. Now, this doesn't just happen because businesses love society. This happens because households engage in something we call consumer expenditure. That is, they take their hard-earned dollars and spend on goods and services that they acquire in businesses. And if you look around your home, you will find items that was purchased by your family. When I say purchase, I
hope so.
Okay.
because we know things happen, right? And we'll talk about that a little later down as well. So businesses send to the households goods and services because the households engage in consumer expenditure and pay for it. Now, the 2 ends of these transactions, consumers buying things and goods and services being sold to them, is what we call the product market. It's important to know that. We call it the product market. And on the other end of that, we have the fact that in order for businesses to even function, households must provide to the businesses factors of production. Factors of production. And we should know what the factors of production are, and that is land, labor, capital, and entrepreneurial ability. You may call it enterprise in some areas. It's the same thing technically. Alright? So cool. And of course, if you are rendering a factor of production to a business, and let's think about it. When you go to work somewhere over the vacation or so, you're doing it for free?
I want my money. I don't like my money to sleep out.
No, you demand what we call a reward for the factor of production. In terms of labor, what you require are wages. In terms of land, what you would require is rent. In terms of enterprise, what you require is a profit. And in terms of capital, what you require is interest. So you need an interest in it, well, you need interest in that case. All make up the rewards for the factors of production. And of course, on this end, we refer to these 2 as the factor market. As the factor market. This is going to come up later on as well. Alright? So please note, this is a simple 2-sector model. On one end, we have the factor market, and on the other end, the product market. Hope you understand. Let's move on. One thing we must highlight for this circular flow of income is the fact that we have a lot of balance occurring. There's a lot of equality occurring here. It's important to know that when consumers spend money, and let's just say they spend $40 billion on goods and services. When $40 billion is spent on goods and services, what do you think is the value of the goods and services that are being sent to the consumers? Essentially, it is the same $40 billion, right? And of course, the question is, where do consumers get this money to spend on goods and services? Well, looking at this diagram, it comes to be quite obvious. The only way they can acquire 40 billion to spend on goods and services is if this $40 billion has been sent as rewards for them providing factors of production. And last but not least, if they were rewarded 40 billion as rewards for the factors of production, what do you think is the value of the factors of production they would have sent? Well, that is the same 40 billion. Now, as we get into national income accounting, what I'm going to highlight to you is the national income identity. And that is a big thing that I need to know here. That's a big thing. Okay? And the national income identity reads as output is equal to expenditure, which is also equal to income. And since this is an identity, you can put it in any order and it still holds true. And of course, these three things actually point to our circular flow. It says that the output, the value of the goods and services, and let me get my yellow, the output is equal to the expenditure, which is equal to the income. These three things are equal to one another. If one is 20, if one is 10, all is 10. I can move it in any form and they will always be equal.
Pretty, isn't it? Perfectly balanced, as all things should be.
Always balanced. That is it. Now on to our next objective. As of this moment, we want to explain the three separate ways in which we calculate national income variables, and that is using the expenditure approach, the income approach, and the output approach. These three separate things allow us to calculate our very notable national income accounting variables in different ways. And it's important to note that despite whatever approach you may take, you will always or should always get the same answer. The example I like to use is imagine that where you live is the answer, and of course you have multiple ways of getting home at any point. You'd always have to take the same road, but the destination always ends up the same, right? So the same thing with these methods. Despite whichever one you take, you are always supposed to get the same answer. So with that said, let's move on to OpenBoard. And before we even get into our explanations, what you need to do as of this moment is pause this video and define the following key 8 terms. These are going to be extremely important for your understanding, and of course it's quite simple to do this. So I would like to allow you to do some research, answer, and remember what these variables are. Nice. So now that we're back here, and thank you for doing the research on those key terms, or not. Good. We're going to start by looking at the income approach. And the income approach is actually one of the easiest ones, because all it requires that you do is assess the incomes that have been paid, and I'll get it read out. Assess the incomes that have been paid to the factors of production. And if you remember, these incomes come in the form of rent, profits, wages, and interest. Great. Typically, you'll get some reading with this, and all you would have to do in that case to get your answer for the income approach is add these up. And of course, you could simply take out your scientific calculator and get the term here that would be called our GDP figure for this economy, or gross domestic product figure for this economy. And when you see it in exams, it's going to be approximately the same thing. It's going to come down to you adding up all the factor rewards and getting your summative figure that's going to count for GDP. Question may contain depreciation, and then you'd probably have to use this figure to work out NDP or some other key economic variable. All right, but once you know the definitions and you know for the income approach you have to add up the factor rewards, everything is going to be fine here. Let's move on to our next approach. To begin our look at the expenditure approach, it's important to know that the expenditure approach actually stems from this aspect of our circular flow, the amount consumers are spending on goods and services. And when we start this approach, this is going to be broken down into the following variables. All right, so let's begin. The expenditure approach to calculating GDP states that it is equal to C plus I plus G plus X minus M. C is defined as consumer expenditure. It's important to know that this consumer expenditure actually contains the value of all goods and services produced from domestic suppliers as well as international suppliers. And if you didn't know the term for that, that is actually called imports. And it's a bit weird, but just note all of that is contained in C. I comes for investments. Investments in this case can be broken down into two things. One thing we call gross fixed capital formation, and what that is the acquiring of new capital assets, street lights, manufacturing businesses investing in new machineries, stadiums being built, etc. And of course, the next aspect of investment is changes in inventories. I prefer to say increases in inventories, which is just the investors topping up any capital that would have depreciated through its use in the financial year. G is government expenditure, X is exports, and M is imports. Now it's important to know GDP is defined a very particular way, right? As we know, it is the value of all final goods and services made within a country within a specific time period, which is typically a year. Now it's domestic. When C contains import expenditure, the end of this equation, we are actually taking that out. It would actually probably make more sense if we could say C minus M plus I plus G plus X, because we've taken out the import figure from our C. It just so happens though, when we see we group these two, the variable we get out of it is net exports, which could be helpful when we're trying to work out other economic variables. So that's why it's grouped that way, okay? All this method requires is that you read your passage and figure out what is attributed to these particular variables. So let's move on. Great, now that we're on the output approach, it's important to note that the output approach tries to decompose, it tries to break down the value of these economic variables into three separate tiers. And these are the three different levels of production: primary, secondary, and tertiary. Now, typically primary, as we know, is extractive industries. So it's like asking, what is the input necessary for crude oil? If we talk in Trinidad, it's like asking you, what is the input necessary for fishermen to get flying fish out of Barbados? Like, the input necessary for that, technically, it's the open ocean. There is no input cost. It's not to say they're throwing a coin into the sea and something coming back. It's not to say oil workers in Trinidad or even Guyana are putting something into the earth, or they're buying something first and then getting crude oil. It doesn't work like that. All right, this is a primary stage of production. So typically the inputs tend to be costed as $0, right? There's a zero value here, but they get to sell that for something. And let's just assume they're selling it at $1,000. The second stage of production needs to buy their inputs from the primary level of production. So the cost of their input works out to be $1,000 because they have to buy it from the primary in order to make this good or service something else. In a sense, it's like the grocery needs to buy the fish from the fishermen. Refiners need to buy crude oil from the persons who take the oil out of the ground to make further refined products, whether it be diesel, premium, etc. The primary extractive industry, the sugar cane needs to be bought in order to make something further. And of course, they have to buy it at this same particular cost. So this 1,000 is what they pay in here. Because this cost of their output, this is the cost of the input to someone else. That 1,000 becomes the input cost. The secondary sector, after putting that good through some process, gets to sell their output for a greater value. Now the tertiary sector is a different game. They must buy from the secondary sector as well, which means the cost of their input breaks down to $2,500, just as our previous stage. The tertiary sector then sells their output for $7. The question is now, what is the value added at each stage? And if you'd like, you can pause this video right now and work out what is the value each level of production has added. Great. In this case, moving from 0 to 1000, the primary sector added a value of 1000. In this case, in the secondary sector, it moved from 1000 to 2500, so it means they would have added a value of 1500. And in this case, moving from 2500 to 7000, it means they would have added a value of what, 4500? Great. The question is, what column here would you take as something that counts for the GDP of a particular country? And remember, GDP tries to calculate the final value of goods and services produced within the boundary. You know the rest. It's important to note what we want to avoid here is a big mistake when it comes to calculating GDP, and that is the problem of double counting. We only want to include the value of final goods and services, not the intermediate goods. And of course, intermediate goods are those goods used up in the production process of another good or service. In that case, if I used it as an input, I do not want to count it towards my GDP because it has not been or it is not a final good or service. In order for us to get the value that we need here, what we need to look at is the value added at each stage. This would give us a total of 7000. It's no coincidence this is equal to the value of the final good that has been sold, because the value of the final good that has been sold here encompasses the value that it would have gotten from the secondary and the primary levels of production as well. These two make sense because they are equivalent. In this case, we have not counted the value of the intermediate goods in the value of the final good or service. This is exactly what we want to do, and that is avoid double counting. And that's it. Some of the basics when it comes to national income accounting. It's important to know that these figures are used not just for inter-country comparisons where you find a country comparing itself to its previous year's performance, but it's also used to compare countries to other countries in the world and possibly the region as well. These things allow for nations to understand if they're moving forward, if they aren't progressing even, how they're doing relative to its competitors, etc. And that's it for today's video. I hope that you enjoyed. I hope that you followed along, and I hope this was helpful in some reason. It would help me a lot if you could subscribe to the channel, like the video even, and of course in the comments let me know if you need further explanation on anything. That's it for today.